I believe Bitcoin's better than gold. So do you. I believe it's more explosive. I think this is just an a priori truth. If you buy a Bitcoin and I buy a Bitcoin and Bitcoin 10Xs, who makes more money? Same. If I borrow 30% LTV against my Bitcoin and buy more Bitcoin and you don't, and it goes up 10X, who makes more money?
You.
Why?
Because you've leveraged it.
Leverage, right? So that's just basic math, right? So why would a Bitcoin treasury company trade for more than one times? Because they're applying operational excellence, management, and leverage. It's not a replacement for Bitcoiners. It's not a replacement for Bitcoin and cold storage. So the question that is most commonly asked in the Bitcoin space is, why should I buy a treasury company, not Bitcoin? And the answer is you shouldn't. The answer is you shouldn't. But they're not competing against for Bitcoiners.
Bitcoin doesn't need to beat the system, but understanding how the system uses Bitcoin is where the real opportunity begins. Mark Moss is a financial educator and entrepreneur widely known for translating Bitcoin, macroeconomics, and market structure into clear financial frameworks. With Bitcoin trading near $95,000 and continuing to show sharp short-term volatility, his analysis places price action within a broader context of liquidity cycles, market sentiment, and capital allocation rather than ideology alone. Bitcoin's fixed supply of 21 million coins, combined with rising institutional interest, creates asymmetric upside that contrasts sharply with slower-moving assets such as gold. Mark Moss explains that many Bitcoiners evaluate treasury companies through a strict sound money and anti-fiat lens. While that framework is internally consistent, it does not reflect how most capital behaves in reality. Fewer than 1% of investors allocate even 5% to Bitcoin, and even committed Bitcoiners typically keep the majority of their wealth in traditional assets. Most investors are not measuring performance against Bitcoin, but against CPI inflation or equity benchmarks like the S&P 500. From this perspective, Bitcoin treasury companies are not competing with Bitcoin itself. They are designed for investors operating within legacy systems and diversified portfolios. Moss highlights that leverage and operational execution drive their appeal, allowing companies to amplify exposure beyond spot Bitcoin. He compares treasury companies to banks and gold miners rather than ETFs. These operating businesses trade at premiums to book value due to management quality, leverage, and future growth potential. Since Bitcoin is more volatile and potentially more explosive than gold, well-managed treasury companies can justify higher premiums, with execution ultimately determining success. Drop your thoughts in the comments, share it with someone exploring crypto, and subscribe for more deep dives like this. Now let's enjoy the interview.
I think Bitcoiners, they take a Bitcoin view into the treasury companies and without realizing that your sound money thesis and anti-fiat and Jeff Booth don't feed the system and perpetuate it and all that, that is ideology, and that's correct. And as a Bitcoin maxi, that's the view I have. But that's not the world that we live in today. So, what percentage of people would you say have taken a 5% allocation to Bitcoin? 1%?
Tiny, yeah.
Less than 1%?
Less than 1%,
right.
maybe.
And so that would be hardcore. Like they'd take a 5%. But even those people would have a 95% allocation to other things besides Bitcoin. So when you start asking like, why would I buy a treasury company and not Bitcoin? As a Bitcoiner, that's what we ask because Bitcoin is our hurdle rate. But 99.9% of the world doesn't ask that question. They're trying to beat CPI inflation, or they're trying to beat the S&P 500.
Yeah.
So they buy a basket of stuff, right? So right off the bat, a Bitcoin treasury stock is not competing against Bitcoin. And Saylor told me in Prague, we had dinner. He's like, I've never targeted Bitcoiners. He's like, I've never brought a Bitcoiner in. It's not a replacement for Bitcoiners. It's not a replacement for Bitcoin and cold storage. So the question that is most commonly asked in the Bitcoin space is, why should I buy a treasury company, not Bitcoin? And the answer is you shouldn't. The answer is you shouldn't. But they're not competing against for Bitcoiners. Even the hardcore 1%ers still have 95% allocated to other stuff.
Yeah.
So most people are not asking, will it be Bitcoin, number one. Number two, I think this is just an a priori truth. If you buy a Bitcoin and I buy a Bitcoin and Bitcoin 10Xs, who makes more money? Same. If I borrow 30% LTV against my Bitcoin and buy more Bitcoin and you don't, and it goes up 10X, who makes more money?
You.
Why?
Because you've leveraged it.
Leverage, right? So that's just basic math, right? So why would a Bitcoin treasury company trade for more than one times? Because they're applying operational excellence, management, and leverage. right? So when you have like a fund, a closed fund, right? And there's, by the way, why would there be more than one treasury company? There's 1,000 closed funds in the US alone.
Yep.
Why is there 1,000? Why isn't there just one fund, right? There's 1,000. Each one has a different risk return profile, right? So with a closed-end fund, a lot of times they'll trade a one-time, sometimes a discount, sometimes a positive, right? A multiple, positive multiple. Why? Because there's a market and people trade it. But when you look at what like a treasury company is more analog to, would be a bank, right? So a bank takes customer deposits, they pay a yield on the deposits, and they invest the money and they make the arbitrage. It's also very comparable to a like gold mining company, a silver mining company. So I'm asset heavy, right? So I have the gold in the ground, but I don't trade at one time as my gold value, my book value, because I'm an operating company. And so I'm going to get a multiple on top of my asset. So the banks are going to trade at 2 to 3 times book value, price to book. An operating company like an oil company or a gold company would trade 2 to 3 times that, because it's not just the gold in the ground, it's also the potential future value of the gold.
Yep.
Right. Oil is a little bit different because oil is so volatile, but like gold companies are priced a little bit different. So if you look at a Barrick Gold or a Newmont Gold, for example, you'll see them like a 2 or 3 times book value, because the gold will be worth more in the future. Plus they have the operating leverage. They can use credit, equity, they can expand, they can do all types of things. So when you look at a treasury company, you go, well, they're more like that. They have an asset like gold. I believe Bitcoin's better than gold. So do you. I believe it's more explosive. So just right off the bat, they should have an increased premium than a gold company because their asset is better than oil or gold, in my opinion. Then we have the operating efficiency. Now, some treasury companies have terrible management and they should be discounted.
Yep.
Some are really good and they should get a benefit. So then the operating company itself, the management, et cetera, is going to get a premium or a discount based off of that. Okay. So that's why it would trade more than 1 times. This type of a company should never trade 1 times. It's not a fund like a ETF, right? They apply no leverage, right? It's just, there's arbitrage against it, which is why the price fluctuates. But really it's negative. Really, it should trade at a discount to NAV because they're charging fees every month.
Crypto treasury companies are transforming Bitcoin from a passive store of value into a leveraged, yield-generating asset for investors. Mark Moss reveals that Bitcoin treasury companies are designed with a strategic purpose: to acquire cryptocurrency assets and apply intelligent leverage to maximize returns. By leveraging Bitcoin holdings through access to credit and equity markets, these companies can outperform simple spot exposure. Instruments like preferred shares, convertible debt, and stock offerings allow them to safely amplify positions. While only a few have reached stage 2, the pre-leverage phase, many are exploring ways to expand Bitcoin exposure through structured financial strategies. Mark Moss reveals that, from a traditional market lens, these companies exist to meet the global demand for yield. The fixed income market, larger than equity or commodity markets, functions on a steady flow of borrowers and lenders. Treasury companies apply this principle to cryptocurrencies, building yield products on a Bitcoin or digital asset standard. Mark Moss reveals that multiple treasury companies exist because each offers unique risk, return, and maturity profiles, similar to bonds. Public offerings, reverse takeovers, and private raises often trigger speculative price swings, sometimes rising tenfold or dropping 90%, without reflecting operational value. Digital Asset Treasury, DAT. Companies primarily hold Bitcoin and Ethereum but are expanding into Solana, XRP, and Tron, offering structured exposure and yield opportunities for crypto investors. Let's get back to the interview.
So the goal, if we just break it back down to first principles, the goal is to have an asset and then use intelligent leverage against the asset, right? Because as we've already previously discovered, if you apply leverage, you're going to outperform Bitcoin. So an operating company that has management, has access to credit and equity markets, and what can they do creatively to apply leverage in a safe, intelligent way? Prefs are one way to do that. Convertible debt's another way. Selling stock is another way. Raising money is another way. So while there's only 3 companies that have gotten what I call stage 2, stage 1 is start buying the Bitcoin. Stage 2 is get to that pref leverage. While there's only 3 that have gotten there so far, that's the path that everyone's hoping to be on.
Yeah.
But there's other ways that they can lever up the Bitcoin besides prefs. what happens is, again, from a Bitcoiner lens, it doesn't really make sense. So we have to sort of get rid of that and think about it from a traditional financial market lens. What Bitcoin treasury companies are doing is they're soaking up the demand for yield. Think about that for a second. The demand for yield, that's the fixed income market. The fixed income market dwarfs the equity market, dwarfs the commodity market. The fixed income market is the biggest market in the world. Why? Because there's always a demand for yield. Some people have assets that they want yield on, and some people need to borrow. Google will drop a bond because they need to build a new data center. So there's always a borrower and there's always somebody that wants the yield. That's never going to change. Bitcoin is not going to change that. Like, that doesn't change the way humans work. We have consumers and creators. Creators create more than they consume. They have savings and they're going to loan that savings out for yield. That's the way, whether it's Bitcoin, gold, or fiat, that's how it works. So the fixed income market is the largest market in the world. Right now, the bond market has built the fixed income market on a dollar standard. What can happen now is we can build the fixed income market on a Bitcoin standard. So there's an insatiable, unquenchable desire for yield. And so we need to build the yield products. Now, to your point about MicroStrategy, why would there be more than one? Like, MicroStrategy's got a cover. They got 4 prefs out there. Like, that's all we need. Then why do we have 10,000 bonds in the United States? Every bond is different. Every bond is a different risk and reward profile. Every bond is a different company. Every bond is a different term. Every bond is a different yield. There's 10,000, not one. Even just US Treasuries alone, there's whatever, 10 or 15 of them, right? From, months to 30 years, right? So there's 10,000 bonds. Why is there not just one? So I had dinner with Michael Saylor when I was in Prague last year, and he gave us this story, and he said, imagine that God came to me in the middle of the night, and God told me that the market was going to crash tomorrow. So I woke up in the morning and I went and hedged MicroStrategy. And sure enough, the markets crashed, but MicroStrategy didn't. That'd be great, right? The shareholders would be stoked, right? No, because they expect MSTR to trade 2 times volatile to Bitcoin. So if Bitcoin goes up 5x, MSTR should go up 10x. But if Bitcoin goes down, we should also go down 2x. How far did Bitcoin drop? 30, 35%? What's MicroStrategy down? 60%. Exactly 2 times. Exactly what the market is expecting it to do. A 2 times volatility. Now, some of these are 80, 90% down, whatever. So like we could look at Nakamoto, for example, right? So if you look at like Nakamoto, the company I'm working with, Satsuma in London, we're also sort of the same victim, but you have to kind of like peel back and look at the nuance of that, right? So again, if we just look at like traditional market finance, let's just use Uber as an example, first of all, right? So Uber started as raising money from friends and family, and then angel rounds, and then VC rounds, and eventually they do a pre-IPO, right? Which is the last investors come in privately before it goes public. So now after 6, 7, 8 years, it finally goes public. What happens? All the insiders sell because they bought it and they were hoping for liquidity, and the pre-IPO investors got in because they wanted to sell as soon as it went public. And it's not necessarily like mean or malicious, but they dump on retail. Not because they're mean or malicious trying to rug pull retail. It's just like they've been waiting for 6, 7 years for liquidity. They finally got it, right? So what happens is naturally, as soon as we hit the public market, all those insiders dump. And then unfortunately, retail bought it and whatever. Okay. Well, a lot of these treasury companies did something similar where they took an already existing trading company, like a public company, and then they did a RTO, like a reverse takeover. And then they raised a pipe to raise the money. Okay. So what happens is, and I can tell you firsthand, because through my fund, Bitcoin Opportunity Fund, we've invested in dozens of these, and I've helped launch a couple now. So like what happens is, like with Satsuma, for example, we announced, because it's already a publicly trading company that you could already buy the stock, we're required by law to make a press release that we're going to raise money. So a press release went out in July and said, we're going to raise our goal is to raise $100 million into this company at the price of 1 pence. And that was the public price at that day. So today it's 1 pence. We're going to raise 100 million at 1 pence. And we put the press release out. As soon as we put the press release out, the speculators started driving the price up. And what we did as a company is we were like, no PR. It was a policy. David Bailey, he didn't really follow that. And so like there's nuances to all this, but this generally applies to asset like Strive's company or Mahler's company or Nakamoto or Satsuma. David Bailey did talk it up quite a bit. So that was a problem. What we tried to do is not talk it up at all, but we had to put the press release out. So we tried to like let it go quiet, but they drove the price up 10x. Mm-hmm. They drove from 1 pence to 10, right? And then we're still raising money. So that went on for a couple months. Then the haters come out. How dare you raise money for the insiders at 1 when the public price is 10? It's like,
yeah, that's just the market. There's not a lot you can do about that.
Then we got delayed. And then, it finally just got approved right before New Year's. And now the price is down 90%. But 90% from what? The company wasn't even an operating company. We just got approved 2 weeks ago. So all that price action in the stock isn't really reflective of what we're doing. And so same with Nakamoto, right? So Nakamoto did this. Now, again, David Bailey was very loud about what he was doing and how much money he was raising. And so that's a whole nother topic that's above my pay grade. And, you know, when Elon Musk tweeted about Tesla stock, he got in trouble. And so maybe there's some wrongdoing there. I'm not alleging there is, but my point is it drove much more attention. Bitcoin Magazine, Bitcoin Inc., obviously, right? And so the speculators really drove that price up big time. Mm-hmm. They got delayed. And then same thing, it dropped 90%. And so it's just a function of what happens when you take a private raise and you go public. It's amplified in that type of a market because you already have a publicly traded company. And so then the speculators start driving the price up. And so it's a function of how it works. But I don't think it's reflective of the operating company because they haven't really been up and operating yet.
Bitcoin treasury companies are redefining how digital assets interact with traditional financial markets by combining asset accumulation with strategic leverage. These companies provide exposure beyond simple Bitcoin holdings, using tools like preferred shares, convertible debt, and stock offerings to amplify returns while managing risk. By aligning with the global demand for yield, they create structured financial products on a Bitcoin or digital asset standard, bridging the gap between fixed income principles and crypto markets. The diversity of treasury companies mirrors the bond market, with each offering unique risk, return, and maturity profiles, allowing investors to choose exposure that matches their objectives. While speculative-driven price swings are common during public offerings or capital raises, the underlying operational strategies and management execution ultimately determine long-term value. Expanding beyond Bitcoin and Ethereum into assets like Solana, XRP, and Tron, these companies provide multiple avenues for yield generation and leveraged growth, positioning crypto as both a store of value and a dynamic investment tool. How can Bitcoin treasury companies use leverage and structured financial tools to outperform simple Bitcoin holdings? Drop your thoughts in the comments, share it with fellow investors, and hit subscribe for more deep dives into digital assets.